And good afternoon. Welcome into Market Talk here on this Wednesday, March 30th. Thank you so much for joining us once again, making us part of your day. I'm your host, Jesse Allen, and find us online, markettalkag.com. It's our home on the web. You can find all of our streaming sources there, iHeartRadio, Apple Podcasts, Spotify. You can find all of our social media links there as well. The latest news of agriculture, much more. It's all online at markettalkag.com. Well, we are looking at a grain market today that recovered somewhat from two straight days of selling and risk off trade. We got a lot to discuss. USDA reports out tomorrow. We're watching the war in Ukraine as well. There's plenty on the table for us to get into, so we won't waste any more time. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here this afternoon. Mike, you know, I didn't know what to expect when we got into Wednesday's trade, considering two straight days of sell-offs, but pleasantly surprised to see us gain back a little bit of what we lost here today in the grain markets. But obviously, plenty of unknowns and uncertainty and volatility lie ahead here yet this week.
Yeah, I think the key with Wednesday's trade, Jesse, to me was we were just kind of swapping positions out from what we did on Tuesday because we just continue to work such a strong theme and headline news surrounding the Ukraine situation. And for, I think, probably the sixth time now, if I were keeping count, we probably bought hook, line, and sinker the idea that a ceasefire was right around the corner in the Ukraine war on Tuesday. And come Wednesday, we find out that there's reports that there's Russian shelling and bombing outside the outskirts of Kiev, where they were supposed to be pulling back. And so I think that this market, I'm very nervous because I've had clients call today, especially with this retracement back up and the idea that we've made a low in the market. I've gotten much more nervous because clients have called in, several of them wanting to buy into this market on a futures basis. And I've had to really wave them off because I'm actually very nervous that the Russian-Ukrainian situation, by it continuing on this long, and some of the missteps we've done in foreign policy here, specifically the president in Poland last weekend talking about the regime change, that was not a secret. The Russian hierarchy, and this has been reported in the London Telegraph and in the Daily Mail as well, that the Russian hierarchy was assuming that the regime change was the mindset of the U.S. and NATO leadership after the war started. And so between that occurring and then this going on and not having any kind of ceasefire on Tuesday, I really am trying to caution the clients and subscribers that the volatility that we could experience between what's going on with Ukraine and what USDA may give us for data points on Thursday's trade is we could have a historic volatility next week. And I really want to sincerely lay that out in today's program if possible.
Well, definitely. And I think about, what you mentioned there, and obviously the war in Ukraine. There's a lot of uncertainty surrounding this. It's been our market driver now since it started. There's worry about what Putin may or may not do at this point, and the headlines seem to change. But then you throw on top of it the volatility and the general, nature of surprise that USDA throws out with these reports coming here tomorrow. And I would agree with you. It just feels like it's shaping up for a lot of volatility one way or the other.
Well, a couple key points that kind of ground us and form a base, I think, in terms of a rationality. Number one, it's clear that the wheat and the crude oil are still leading this market up and down at this stage. And so I don't think we've traded a lot of the USDA data hardly at all at this point. Maybe we did on the close on Wednesday when the spread started to firm for the corn, because I think the trade going into the USDA reports, both grain stocks and acreage, are probably leaning towards a tighter grain stocks number for corn, but a bigger acreage number for corn. So that makes sense why they would want to come in and support that bull spread on the close. And I think maybe we saw that as well in the wheat market when it came around on the close as well. Beans, though, we saw them come off their highs quite a bit and kind of pull back some in the mindset, I think, that they're probably a little bit more nervous about the grain stocks report in the soy complex. Even though we've had some good exports, it just didn't seem like it's been hitting the mark that we've wanted them to hit for probably 2 or 3 months at this point, with Brazil coming online, right here, right now. So that's point number one. Wheat and crude are still leading this market. So it's still a Ukrainian commodity market. I think point number two is when the Ukrainians say that they are finding mines in the Black Sea and that they're trying to ship grain from another country, from their country to another country. This is going to take forever to get that grain out. And I think that goes back to, if the Russians do not leave Kiev, then that's their main corn planting area. That central, north central area of Ukraine is their major primary corn belt. So I think these are the key things to think about when it comes to the grain side of the equation. Now, if you turn to the energy side, we found out today by the Department of Energy that our strategic petroleum reserve is down to its lowest level since May of 2002. And we're cranking up the refining. We're and drawing down the stocks so significantly because we are cranking up the utilization at the refiners. And our refinery utilization is the highest since January of 2020. And so we are seeing some refined product supplies come online, but we keep draining the tank on the crude oil supplies. And so this is why the kind of the straw that broke the camel's back for me, because we've now given us pretty good support levels of ideas that wheat and crude are leading this market. The big thing that hit me was an article from the Asia Times today that said that the Kremlin essentially released, like let out of the cat out of the bag to the West and through a news agency, TASS, that they were dispersing their central leaders, all their big leaders, including Vladimir Putin. They were dispersing them out amongst the country into kind of silos in preparation for what could be a nuclear type scenario. And I think this is where what my job as a commodity analyst to do is to try and look around the corner and see things maybe before the rest of the markets do, or rest of my clients do. And what I'm starting to feel very sincerely is that this guy's getting backed into a corner from a variety of ways. And by this kind of rhetoric ramping up in some of these foreign newspapers, I really do feel like we're getting closer and closer to maybe a Cuban Missile Crisis scenario. And that's kind of the volatility I'm talking about. And that's why I wanted to kind of show you that in some of the charts that we are going to show the viewers today.
Definitely. Well, and scary stuff, and we hope it doesn't come to that. I want to
Right.
move to this chart here, and let's talk about this. And I know that this has the VIX in it, the volatility index, and that's something we've heard a lot more about lately. That fear index on Wall Street. But walk us through what you're seeing on this chart, Mike, and some of your thoughts here.
Yeah, the purple line is the just outright Bloomberg Commodity Index, which would include both energies, metals, softs, and everything out there that is traded in the Bloomberg Commodity Index. So that's your purple line. The yellow goldenrod kind of color line is the Bloomberg Grain Index. So it's the sub index pulled out of just the grains from that Bloomberg Commodity Index. That you see these two lines, the purple and the yellow, trend really nicely with one another. Especially since the financial crisis, and that you can see why the crude oil market tends to lead the grain markets in this chart, Jesse, because the purple line goes up higher oftentimes than the yellow line. Well, that's because your energy is usually driving the market higher. So the green line, as you say, that's the VIX, that's the volatility index measured off of S&P 500 at the money options. And it's the fear factor, the fear gauge in the S&P 500, or the fear factor the market looks at in the equities market specifically. And we've noticed the equities markets have just charged higher and higher and higher, regardless of how long this war is gone. I mean, there's been pullbacks, but it's been dips to buy for the equities people. So what I wanted to start looking at was, okay, what's the VIX doing? Well, the green line is the VIX. You see it's been going down pretty consistently and substantially, and it's below 20% now. You can't see it on this chart, but right now it's below 20%. So that's a pretty low number, and that gets you back to levels of 2013, 14, all the way through 2019, 2020. And so the market fear is not in the market right now. So that's point number one. That really concerns me because of what we just laid out to the viewers. Point number two, and this is probably good whether the VIX has any kind of material movement in the markets or not, or whether what we're talking about unfortunately would happen. This market shows you pretty clearly between the purple and the yellow lines that the purple line's moving much higher than the yellow line at this point. The grains are not moving as high as the overall commodity index. And because we're still in a wheat-led market and a crude-led market, I think we're still like 2008. And that's the highlighted area in red is the 2008, 2009 scenario. So with the Corn Belt starting to get more rains in some key areas, not out of the woods yet, but certainly improves in the last 3 weeks. And what we're seeing with the Ukrainian war, I'd say my model year is still 2008, and it's still a wheat-led, crude oil-led market. And the big question for me analytically is, does Thursday's USDA numbers do anything to change that?
And that's going to be the big question, Mike, is, what does USDA throw at us tomorrow? Those numbers, as of March 1st with quarterly grain stocks and planting intentions. And I mean, we were just, we weren't too far into the Ukraine situation. So one has to wonder, will there be some numbers there that are, maybe unexpected that, fast forward to now, they should be maybe a little bit different. I think that's something to watch for.
Yeah, and this is where I'm going to parse it out and say, based upon other colleagues that I've been doing media things with, talking about the acreage and stocks report, I'm getting a very strong sense that all of us in the analytical world feel like the acreage numbers are going to change right after Thursday. They're going to be different. So I think the market will give the acreage numbers a pass as long as they're not above or below the highest trade guess. The grain stocks numbers, though, those are going to be the solid numbers that tell us implicitly what the demand has been and therefore what the supplies are. And they could make a very big splash in the pool if they're low, especially. And I think this is especially the case for corn. If we have low corn supply numbers as of March 1, that's going to put more pressure on the new crop corn to get planted. And I think that helps the spread, but it also helps the new crop corn as well. And actually maybe is even more important than the acreage base. If for instance, we would drop below 2 billion bushels on the March 1 stocks for corn, Jesse, I think that would be a substantially price friendly number. The trade is not expecting. We're actually expecting a little bit higher than last year at this time. I think it could come in at last year at this time, or maybe even a little bit lower, just because of our domestic consumption and our export consumption has been so strong.
Well, Mike, let's shift over to livestock. And today, the hog market started lower. Then we saw a little bit of, gains in the summer months. And we kind of backed off that here. I wish I had an in at USDA to get the quarterly hogs and pigs report here early, where we don't have it quite yet as we're talking. But I know the trade's going to be looking at that going into tomorrow. But what are you seeing in this hog market and the cattle market? I know that this cattle hog spread, I'm going to pull this chart up as well. There's a lot of interesting things going on here with that spread as well.
Yeah, and what's neat about this? It's kind of like the Bloomberg Commodity Index. A model year is what I'm looking for because of the supplies that we're dealing with and the demand that we're dealing with in both hogs and cattle, Jesse. And so my model year right now is 2014 and heading into 2015, and that's what I have highlighted in blue. And what's really neat about this as we go into that hogs and pigs report, I think the big number obviously is going to be the all hogs and pigs as of March 1. The average trade guess is 98.8%. The top end is 99.5%. The bigger the hog supply, the less premium the hogs need to have, or the bigger discount the hogs need to have when it comes to the cattle. But if you look at the spread, it's pretty remarkable because right now, April minus April fat cattle minus April hogs are trading right around $15, $16 premium to the cattle. But in just a few weeks, 3 weeks from now, we're going to switch from April to now then being June and April or June. And the June hog spread is actually only plus $14. And so you're looking, the current price is around $35. If we went to June, it'd only be about $14 or $15. And so we could actually go down once the April contract goes off the board and go down and match those lows of 2014. So that's where these support lines, that green support line, becomes very, very important. Why am I going through this? Because what we've seen here the last few weeks, and you nailed it here when you introduced the whole livestock sector, is the hogs have really been the showstopper. They're the ones that are really running higher. I mean, we've got 138 June cattle, but we've got 124 June hogs. And so they have been an enormous support layer here underneath the cattle market, even though their exports haven't been as good, especially going to China. So that's what I'm getting out of the hogs and pigs report, is that the smaller the hog supply, the more likely that the hogs will gain on the cattle, but that in turn will probably be very good for the cattle market as we go 2, 3, 4 weeks down the road, and it maybe will allow us to get into the mid 140s, upper 140s for the June cattle, and maybe even get into the 150s, low 150s for the December, the deferred cattle. So this is a pretty big report because of the way these cattle and hogs are working together.
Well, Mike, do you think with the hogs, with just hogs being the showstopper lately, do you think some of that is maybe demand driven? Is it because folks are not wanting to buy expensive beef and maybe they're shying away from chicken and turkey because of everything going on with bird flu? I mean, do you think that has something to do with it, or just are we buying more pork at the grocery store right now?
Yeah, I do think it could be taste and preference, and I do also think that in this the cold storage numbers didn't really support this idea, but I do think that we are losing some supply on the poultry side, and pork is very easily filling that gap when it comes to the available supplies in cold storage. But I will have to say, I looked at the steak prices where we are now in the retail level versus where we were a year ago when it was pretty elevated, but we've come down a lot in some of the really good cuts of steak. The ground beef prices, for the most part, are coming down a lot versus last year at this time. We're really going into the summer grilling season where the beef looks very, very strong price wise. But you're right. There's something going on with the pork because the cutout is not where it's at for no reason at all. And so I think it really is a situation where maybe we're a little bit tighter on supply. We're still down about 7% year to date on production and slaughter. But I think also that HPAI, which is back in the news again on Wednesday, with more farms in Iowa having some more HPAI being found, I do think this is starting to bleed into the price action. And that's why, again, the hogs were going to be the biggest fear factor for me, Jesse, analytically, as far as what they could do to pull down cattle. They're actually turning into the exact opposite.
Well, and on the cattle side as well, starting to see some cash trade trickle in. One has to wonder what that's going to look like. We had a pretty bearish cattle on feed report that it felt like the trade mostly, factored in as we got into this week. I know some people have been happy with how cattle have traded, but I know moving forward, be interesting to see what cash looks like. What do weekly export sales look like next week? Are they strong again? I think that'll be some keys for the cattle market specifically.
Yeah, and we haven't been able to parse through and get through the feeder cattle market because it's been the corn market and the feeder market. We don't really know now. My cash traders, my feeders out there, they're getting good prices right now for their feeders. They're doing very well. They're pretty happy with what they're able to get as far as sale prices. And Oklahoma City continues to be pretty underpinned at this point in their feeder reports. But we got to get kind of out of the corn feeder spread and then be able to see maybe a little bit more clearly and get out of that fog. My sense is that because the marketing's number on the cattle on feed report beat the highest trade guess, that's kind of what saved us from going just straight down because of the placements and the on feed numbers, as you're kind of as you alluded to. I'm hopeful we'll see a very strong cash market develop here by Friday's close. It kind of underpins that marketing's number that Packers are pretty much short bought at this point.
All right, Mike, floor is yours. I know we got a lot of stuff coming our way tomorrow. Any final thoughts you have for us today?
I've laid out a lot today in a short period of time. I want the listener and the viewer to understand there is a lot of research I've been putting out here that kind of revolves around some of these conclusions that I've come up with between you and I, Jesse. So please sign up for a 3-month trial for $150, and I think you'll get a lot out of it and kind of it'll make a lot more sense why the geopolitics and that global macro trade are such an important part of our price action right now. They're not always this way, but it sure looks like for the foreseeable future, they're going to remain that way.
Well, you can find all that information and sign up for that trial online, globalcomresearch.com. That's globalcom with 2 M's research.com. And you can stay up to date with everything Mike is putting out there. And Mike, I appreciate the time as always, sir. Thanks for joining us this week. Have a great week and weekend, and we'll talk to you next week.
Thanks, Jess. You do the same. Appreciate you having me.
Mike Zuzolo, Global Commodity Analytics, our guest today here on Market Talk. That's going to do it for the show on this Wednesday, March 30th. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.